In recent years, Calgary has adapted its housing stock to accommodate a diverse array of demographics and immigration influxes, making it a unique property market in Canada. However, as the global economic landscape shifts and the treadmill that sustains Canada's economic success is at risk, Canadian provinces and Ottawa must navigate a series of policy changes and challenges to remain competitive. Factors such as an aging population, increased foreign investment in real estate, and an influx of capital-seeking refuge from economic turmoil abroad are creating a complex environment for Canada. As the Trudeau government attempts to regulate foreign ownership of real estate and attract a younger workforce, the country must also contend with the pressures of a reindustrialization and securing capital for the future. In this dynamic period of North American history, Canada faces a critical turning point that will shape its economic and demographic future.
So what is it about Alberta that makes its housing stock set up the best for its demographics and for immigration?
Sure. The tar sands boom really got going about 15 years ago. And in the first year, the Albertans were attracting people from all over Canada with a heavy emphasis, of course, on the Maritimes because the economic dislocations there have been pretty rough. But most of the people who were coming were in their 20s. And that meant they were mostly men. And within a couple years, it became apparent that Calgary really needed to recruit a wider array of people in order so that these people were not doing what happens in the United States and just living in band camps. And so the decision was made early on to put a lot of effort into building larger apartments and single-family homes so that these young men who were coming in could actually have a reason to bring someone with them, maybe bring kids with them. And then the expansion of the economy within Calgary itself attracted a lot of women from all parts of Canada in order to do the non-oil jobs. And all of a sudden, you've got people from BC and people from Nova Scotia falling in love in Calgary and buying a single-family home. And it's the one place in Canada where most of the housing construction was not catering to foreigners. So it wasn't just condos. It was actually people who wanted yards. And that made for a very, very different property market in Alberta compared to everywhere else. Now, to this point, Canada has always had a trump card: immigration. As long as you are bringing in people in their 20s and their 30s and their early 40s, people have already finished their primary and secondary education somewhere else, so you don't have to pay for it. But then they come in and they work for 30 or 40 years before they retire. You have been able to function on a bit of a treadmill. The people who come in, as long as they're young enough, have enough time to pay into the system to then pay for their own retirement. But if they don't come in until they're in their 40s, they will never pay in enough to justify the budgetary expense that it takes. Until recently, this is just barely held up. But what has happened under COVID is the input pipeline has stopped. In addition, the nature of immigration that you've attracted in the last years has been dramatically different from what's come before. It's no longer people who are coming to work and live forever. It's people who come and drop some money, maybe establish residency, but don't actually work and then move on. And they use their financial assets to buy physical assets in Canada, primarily real estate, that they then do not live in. And because they're either fleeing the European financial crisis or the Chinese breakdown, they're relatively cost insensitive when they're evaluating property. Because from their point of view, if 10, 15 years from now, the property is only worth half what they paid for it, for them that's still a win, because it means they got half their money out of a dying system. That has been your primary investment portfolio for the last few years. And that means that most economic activity in some of your provinces has been real estate based, upwards of 30, 40% in BC specifically. And a lot of the Canadian provinces are getting 3, 4% of their tax intake from nothing more than transferring titles from one real estate owner to another. That treadmill is now breaking down. Two things. Number one, the world is opening up a little bit more. And so there's a different class of people that's looking to leave as these other systems really approach the brink. They're older, they have more money. So all the distorting things that we've been talking about here are going to get worse. And second, because so many foreigners have bought so much property in so many gateway cities in Canada, a lot of Canadians cannot afford to live in their own country anymore. That has a political impact. And so the Trudeau government, effective January 1, has put restrictions on the ability of foreigners to own real estate. So how will this all shake out? Way too soon to tell. The ban's only been in place for a week and a half. And it's going to change the nature of who's coming to Canada. And we're already feeling that pressure south of the border as some of it diverts. As a rule, all else being equal, most foreigners would rather be in Canada than the United States. It's considered more politically friendly. Or it was until January 1. And now the economic issue really, really, really matters. Deal with the last factor, the fifth one. What we're looking at here is American data again. The gray and the yellow is the same as that first slide. So that's net worth by decade. And that's everyone, that's average. The blue and the orange is median. So it removes the top and the bottom 1%. In the United States, half of all financial assets are held by the top 1%. And that means that in the United States, yes, we have a massive inequality issue. We're not going to solve that on a podcast. But it also means that when you retire, if you're in the top 1%, you don't have to liquidate your entire portfolio. You probably only liquidate a third or a half of it. And that leaves a significant amount of capital engaged. The challenge that Canada is going to face is it has a more traditional wealth distribution, so domestic capital is dropping significantly and will stay low for a very long time. That means imported capital is what's going to be driving it. The United States is going to be the source for most of that simply because of this disparity within our own economic equality on the south side of the border. And then third, you're going to have a lot of desperate, hungry, scared money from the wider world looking for a way to land in Canada in an environment of a real estate block. A lot of moving pieces that are going to require both the provinces and Ottawa to come up with different policies. What Trudeau has done on the first, it makes sense to me. Whether or not it's going to work, I do not know. But I know it's kind of only the opening gambit for the changes in policy that we should expect to see over the next several years. And if you play it wrong, the treadmill that keeps Canada functioning stops. And that, among other things, might mean that Canada is not able to participate in the reindustrialization of North America. Because if Canada can't draw those people in, it no longer has the workforce that is necessary to do the reindustrialization in the first place. So there's a lot of things that get tangled up here that Canada is going to have to assign values to and then muddle its way forward as we enter the most dynamic period in North American history since the War of 1812.
To conclude today's episode, several factors are contributing to increased pressure on the Canadian economy and housing market. These factors include the demographic shifts as baby boomers retire, millennials look for more affordable housing, and a decrease in public transport usage due to COVID-19. Additionally, the changing nature of immigration to Canada and the recent restrictions on foreign real estate ownership have impacted the housing market. Lastly, the shifting capital availability, influenced by an aging population and the need for reindustrialization, further complicates Canada's economic landscape. To navigate these challenges, Canada needs to develop policies that encourage investment in sectors other than real estate and effectively manage the influx of foreign capital. This will be crucial to ensure the country can participate in North America's reindustrialization and maintain its economic stability.